Picture this. You're 19 years old, you pick up a single book, and reading it completely changes the entire trajectory of your life. Well, that is exactly what happened to a young Warren Buffett. He famously claimed that The Intelligent Investor by Benjamin Graham was quite simply the best book on investing ever written. So, welcome to this explainer. Today, we're going to break down the exact principles from that very book, literally the principles that built one of the greatest fortunes in human history. We are bypassing all the hype, and we're going to learn how to actually build wealth for the long term. Okay, let's dive right into this. We've got a 5-step journey today. First, we'll meet Mr. Market. Then we'll separate investing from speculating, discover the all-important margin of safety, choose your style, and finally, master your emotions. We're going on a chronological journey here to shift your mindset from a totally anxious speculator to a calm, calculated investor. All right, step 1, meet Mr. Market. This stage is all about changing your perspective by introducing Benjamin Graham's most famous and, honestly, most misunderstood concept. To really grasp this, I want you to picture a scene. Imagine you own a local coffee shop. It's highly profitable, it's super steady. I mean, it's not glamorous, but it makes really good money, you've got your regular customers, and the profits are incredibly consistent day in and day out. You absolutely love this business. But there's a catch. Every single morning, your weird, highly dramatic neighbor, let's go ahead and call him Mr. Market, rushes into your shop with a wild new offer to buy your business. So day one, he storms in, completely frantic. He slams his hands down on the counter and yells, "I'll give you $1 million for this place. Coffee shops are unbelievably hot right now." You look at him, you kind of chuckle, and you think to yourself, well, that sounds completely insane, but noted. But then, the very next morning, he drags himself through the door. He looks absolutely miserable. He slumps into a chair, sighs, and tells you that coffee is dead. Nobody drinks it anymore. He drops his offer to 50 grand and warns you that you better sell to him right now before it's too late and you lose everything. Then, we rapidly pivot to day 3. He bursts through the door, completely changed his mind yet again, and bumps his offer back up to $700,000 because suddenly the news told him coffee is cool again. So let me ask you, would you actually take this guy seriously? Of course you wouldn't. No way. You'd roll your eyes and tell him to come back when he's sobered up a bit. You would never, ever sell your solid, cash-flowing business based on his unpredictable mood swings. And yet, surprisingly, this is exactly what millions of people do with the stock market every single day. Because the stock market lives on a screen and looks super official on the news, people treat its daily price swings as serious instructions, rather than what they really are, pure emotional drama. And that brilliantly illustrates our core takeaway for this section, captured perfectly by Benjamin Graham. The market is there to serve you, not to instruct you. The smart move isn't to take instructions from Mr. Market's emotional meltdowns. The smart move is to use his panic to buy things cheap. Just think about the 2020 crash. Incredible companies like Apple and Microsoft got massively cheaper almost overnight. They didn't suddenly become bad businesses. Mr. Market was just having a massive meltdown. Intelligent investors use that panic to buy high-quality assets on sale. Moving on to step 2, investing versus speculating. Now that we've shifted our perspective, we need to change our actions and completely reframe what we are actually doing with our money. There is a stark contrast between these two approaches. True investing, it's calm, it's thoughtful, it's long-term. It's exactly like buying a house you actually plan to live in. You check the neighborhood, you inspect the plumbing, you look at the school districts. Speculating, on the other hand, is totally different. It's like buying a house completely blind, just because your barber said prices are going to the moon next week. This is exactly what happened back in the late 90s dot-com bubble. People were just throwing their life savings at literally any company with a .com in its name, just hoping to get rich quick off the hype, rather than any underlying value. So think about this for a second. Would you buy a tiny piece of a local pizza shop you've never even seen, you don't know the owner, and you have absolutely no clue if it even sells pizza? No way, right? That would be ridiculous. So we really have to ask ourselves why we blindly buy stock in meme companies we don't understand just because some TikToker hyped it up online. We have got to stop treating stocks like a scratch card. To finally step out of that speculator mindset, you've got to follow Graham's 3 strict rules for investing. Step 1, do your homework. Step 2, protect your money. And step 3, expect a reasonable return. You aren't hunting for a 10x overnight miracle here. You are remembering that a stock is partial ownership in a real business with real employees, real products, and real revenue. All right, step 3, the margin of safety. This is all about shielding yourself from the unknown. So the crucial point here is that even when you do your homework, you must protect yourself because the economy can flip abruptly. And hey, even the smartest people make mistakes. To really visually anchor this concept, let's use a brilliant engineering analogy. Imagine you were tasked with building a bridge, and it's specifically for trucks that weigh exactly 10,000 pounds. Are you going to build that bridge to hold exactly 10,000 pounds and not a single ounce more? No, of course not. Engineers build it to hold 30,000 pounds, just in case. That extra 20,000 pounds of strength, that's your safety margin. Well, in finance, you need that exact same cushion. If you do your research and find a stock that is intrinsically worth $50, you don't buy it at $50. You wait for Mr. Market to panic, and you buy it at $30. That gap is your financial cushion. It's exactly what Warren Buffett did during the 2008 financial crash. He was buying up incredible companies for pennies on the dollar simply because he demanded a margin of safety. Now, I know exactly what you're thinking, but what if I love a stock like Apple and the price just keeps soaring? Oh man, the FOMO is so real. But let this quote from Buffett guide you. The stock market is designed to transfer money from the impatient to the patient. A great business at the wrong price is still a bad deal. If you don't have your safety margin, you do not chase it. You stay patient, you put it on your watch list, and you just wait for Mr. Market to throw a tantrum. Step 4. Choose your investing style. Time to commit to a strategy. To avoid years of absolute frustration, you have to honestly pick one of 2 lanes, and you've got to stick to it. Think of this choice kind of like going to the gym. The defensive investor is like the casual gym jogger. They show up, do some light cardio, and really just want to stay fit to avoid injury. They want safe, passive growth. The enterprising investor, though, that's the hardcore bodybuilder. They track every meal, they take supplements, they log every single lift for maximum gains. They want massive results, and they're willing to put in the grueling work to beat the market. Both are incredibly smart strategies, but you must know which one you actually are. So, let's look at the actual tactics for these 2 styles. For the defensive investor, this means buying broad, boring index funds like the S&P 500 and dollar cost averaging into them every single month, totally regardless of what the news says. But if you're the enterprising investor, you are digging deep into financial statements and actively hunting for undervalued stocks. And I must warn you heavily right here, do not play in the middle. If you try to pick individual stocks without putting in that hardcore bodybuilder level of research, you are absolutely going to get wrecked. Let's move to step 5 and see how this all builds together. Master your emotions. This is the psychological glue that holds your entire financial system together. Consider this hard truth from Benjamin Graham. The difference between successful investors and broke ones isn't intelligence, it's emotional discipline. Think about how true this is. We watch people completely panic and sell off their entire portfolio over a tiny 5% market drop. Or on the flip side, they blindly YOLO their life savings into some random stock purely out of greed and Twitter memes. If you lack discipline, I promise you, none of the math matters. Just contrast these 2 mindsets for a second. The panicking crowd is literally like a terrified passenger yanking the steering wheel of an airplane during a little bit of turbulence. It's a guaranteed disaster. But the intelligent investor? They're the pilot. They stay calm and they simply follow the flight system. They stick to their dollar cost averaging, they rebalance their portfolio, and they completely ignore the outside noise. Remember, your job isn't to control the market. Your job is to control yourself. Which brings us to our final, provocative question that I really want you to leave with today. Are you building screenshots of your account just to flex right before a crash? Or are you building true, long-term wealth? Real wealth requires treating stocks as real businesses, protecting yourself with a margin of safety, committing to your style, and holding that emotional line when everyone else is losing their minds. So the next time Mr. Market bursts through your door in a complete panic, what will your response be?